What are safer than banks? In this episode, I'm going to address why does a max-funded IUL provide liquid access to money in times of need better than a bank? Get ready. By the end of this episode, you will understand why legal reserve insurance companies survived the Great Depression when many banks didn't. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for more than 48 years. And I've helped a lot of people optimize their financial assets, minimize taxes, and empower what I call their authentic wealth. So on this three-dimensional wealth channel, I'm very passionate about giving you insights into opportunities that maybe you didn't know existed before. So if you watch a lot of the episodes on this channel, one of my favorite financial instruments that allows people to be able to have liquidity and safety and predictable rates of return tax-free is a max-funded indexed universal life insurance contract, which in my opinion blows out of the water traditional IRAs and 401ks invested in the market and so forth, because you eliminate the dangers of taxes, inflation, and market volatility. A lot of financial advisors do not understand what I mean by max-funded IUL. Now, I'm going to admit that probably 99% of IUL insurance policies out there in America would not be deemed a laser fund, which is what I call a properly structured maximum funded indexed universal life. Makes all the difference in the world so that you can earn net internal rates of return, cash on cash, of 8, 9, 10% and even higher, tax-free. I've averaged 9.62%. ever since 1997 when indexed universal life was first introduced. Some of the key elements of a prudent investment are liquidity, safety, and predictable rates of return. So in this episode, I'm going to talk about liquidity. Now, liquidity is the ability to access your money when you need it, maybe with an electronic funds transfer or a phone call, okay? Sometimes people get confused with convenience. What gets a lot of business owners and real estate investors in trouble is lack of liquidity. And so I've always said leverage without liquidity is stupidity. Because every story I've ever heard of people that leveraged, owned a lot of properties, but they didn't have any liquid money available. It was all tied up in the equity of their property because they borrowed 80% loan to value, and then they took all of their positive cash flow and plowed it into the mortgage to try to get out of debt the dumb way, okay? You kill your liquidity because then when you get into trouble, the only way you can access that money is to borrow it back or sell it. And when you need it the worst, it's the hardest to get to be able to qualify to borrow it out and or sell it in a soft market. So a lot of times business owners, when they get over leveraged, if they lack liquidity, they get into trouble and they end up going out of business, or they borrow at exorbitant interest rates and so forth, and that causes them to go out of business sooner or later. So there's a lot of scenarios where real estate investors, business owners, just general, people in America, they get into trouble, they lose their home in foreclosure because they lacked liquidity. They thought they were doing the smart thing, taking all of their money and giving it to the mortgage company and not having any liquidity. And then when things go bad, they lose their job or the market goes down. I'm talking about the real estate market. They have to sell. They lose all that progress they made by sending extra principal payments to the mortgage company because now it's all for naught. Is this making some sense? This is critical. Liquidity is the number one rule or the number one key element to a prudent investment, in my opinion. And so many times people put it, third or fourth down the list. Before I go any further, I'm going to explain the biggest mistake people make, confusing liquidity with convenience. I want to encourage you to share this video with someone who ought to watch this information. Post a comment, click like. But I would really encourage you to subscribe. It's free. And when you do, you click subscribe. You also click that little bell because then you'll be notified every time I post a new episode, which I do almost on a daily basis. So this is about you. It's not about me. I want to educate you. I'm 70 years old, and I don't want to go to my grave without helping you avoid some of the mistakes I've made throughout my life. And way back early in life, I learned that lesson the hard way, that you must have liquidity. So let's talk about how people get confused. Sometimes people think liquidity means convenience because they tell me, well, I have X amount of dollars down at the bank or the credit union because it has a drive-up window and it's just down the street. No, that's convenience. Well, yeah, but it's liquid. I can go get my money. And they even give me a sucker or a treat for my dog if my dog's in the car with me, you know. I go, no. Truth be known, a bank or a credit union under federal law regulations, if things got really, really bad and there was a run on the banks can say, sorry, you cannot have your money on deposit here for 6 months until things calm down or until the federal government bails them out in FDIC. But FDIC is just an insurance, FDIC, Federal Deposit Insurance Corporation. But who's running that insurance company? It's the federal government. They're not very good at running things, and that's why FDIC has been technically broke a few times. The first time, that I remember was when they bailed out the savings and loans. But see, the federal government has the ability to print money and tax us, and so people feel pretty good with FDIC. I'm not trying to scare you here, but the fact of the matter is, if they are insuring your deposits and they're running that insurance company, they have to print money sometimes to be able to meet that obligation. Why not use the multi-trillion-dollar legal reserve insurance industry, which is where banks and credit unions and the government goes to when they get into trouble? Because they have reserve requirements that they have to have money on hand, liquid and safe, in the event of a catastrophe, a run on the financial institutions. So let's talk about how many banks went under in the Great Depression, and let's go to 2008 to help you understand this. In the Great Depression, banks closed. 40% of banks never reopened again. They were gone permanently. Now, how many legal reserve insurance companies went broke or under in the Great Depression? 0. Now, they came through crediting 2.5%, 3%, but they're the backbone of America because they have legal reserves they have to have on hand. They don't loan money out on real estate at 80% loan to value. If they loan money on a big skyscraper or shopping mall, maybe it's only 50 or 60% loan to value. They have huge cushions. If they have to foreclose on a skyscraper, they usually come out smelling like a rose, okay? And so they buy AAA and AA bonds. If they get into stocks, it's very conservative stocks and so forth. But this is why the legal reserve insurance industry has weathered those kinds of storms when banks went under, because a lot of their money was loaned out to the general public. In fact, the only safe money in banks was what they invested into insurance companies. So let's fast forward to 2008. In 2008, 400 banks went under, okay? 900 more were on the brink, on the watch list. And so the federal government, and by the way, a lot of Americans don't understand how close we came to a total financial collapse in 2008 in America. I'm not going to go there right now, but the federal government asked the 5 major banks in America to disclose where they had their tier 1 assets for liquidity and safety in case of a run on the bank. They disclosed that 30 to 40% of their money was invested into the legal reserve insurance industry. Sometimes in the form of BOLI, that's bank-owned life insurance, okay? Who do they own it on? Doesn't matter. They're stockholders, they're chairman or whatever. They own the insurance policies. They get all the tax-free accumulation and growth, and they were borrowing our money at 1% or less. In other words, there's only 4 things you can do with money: spend it, lend it, own with it, or give it away. When you have your money in a bank or a credit union or an insurance company, it's in a lended position. Are they just a benevolent institution paying you interest, but your money's in a vault? No. What are they doing with your money? They're loaning it back out again. They pay you 1% and they loan it back to business owners or people who are buying homes or whatever at 5%. How much more is 5 than 1? Don't say 4. It's 5 times. It's 500% more. On every million they borrow, they pay 1%, 10 grand, and they turn around and they make 50,000 or 5%. Hello? Would you buy a widget machine for 10 grand that made you an extra 50 grand? Would you hire an employee for 10 grand that made you an extra 50 grand? That's called a 500% return on employment cost or equipment cost. But see, the banks disclosed in 2008 that they had it in insurance companies earning, 5 times. So you can bypass the middleman and increase the liquidity and the safety by just putting your money directly into an insurance company, even an emergency fund, because you can access your money with an electronic funds transfer phone call. It's very, very easy. So if you need to access money out of an insurance contract, my favorite vehicle is what I call the laser fund. Laser is an acronym that stands for liquid assets, safely earning returns. So if you need to access money out of an indexed universal life policy, I have many savvy business owners that do this. They just say, oh, Doug, I need, 100,000, 10,000, $1 million. In 2017, I had a business owning client that needed $1 million out of their IUL policy, and they know how to do it. They say, send me that form. I email over the form. It's one page. They put their name and their account number, which is their policy number. And then they have one of two choices. Do you want to withdraw $1 million or do you want to borrow $1 million? Now, they understand how money works. They could withdraw $1 million, but now they're not earning interest on that anymore. Now, the loan, if you use that provision, people say, why would you borrow? Well, the insurance company will loan you $1 million based upon the $1 million of collateral you have sitting in your policy. So why would you do that? Well, there's 2 ways to borrow. You can borrow, let's say, at a zero wash or zero cost loan, and in order for that money to be tax-free, the IRS says they have to charge at least a minimum interest rate. So they charge you 2% on the $1 million loan, but they credit the $1 million that you have as collateral with that same 2%. It's called a zero wash loan. You know what many savvy business owners do? They say, well, charge me 5%. Why? Because they'll credit you whatever the index does that year. In 2017, this client earned 25. So they paid 5% on $1 million, 50,000. They don't have to write out a check for that. But they made 250,000 minus the 50. They netted 20% or 200,000 tax-free on their $1 million, while they were technically using the $1 million in their real estate investments. People go, whoa, I've never heard of this before. See, the reason why they are savvy, because they understand liquidity is the key element of prudent investing, but you want to leverage with liquidity. If you leverage without liquidity, that is stupidity. So if this is intriguing you, I want to show you how you can learn more about a max-funded IUL and why I think it passes the liquidity test with flying colors. And that's where I keep my serious cash in case I need to access it. So I want to gift you a copy of this best-selling book. It's flying off of our warehouse shelves. It's called The Laser Fund, which is actually 2 books in one. This white-covered side is 200 pages, 14 chapters. It has all the charts and graphs and explanations of how to diversify and create the foundation for a tax-free retirement. If you learn more by stories and examples, you flip it over and read this one. This is 12 chapters, 100 pages with 62 actual client stories. If you want to use both your right brain and left brain, read both of these books. But you simply go to laserfund.com, click on the link below. You contribute a nominal amount toward the shipping and handling. I'll cover the rest of that cost and I'll pay for the book. I'll fire out a hard copy to you, 300 pages. But there's options there to listen and learn, watch and learn. There's even an 18-hour masterclass if you like to dive deep and optimize your assets and increase the liquidity, safety, and rate of return of your money.